We live in Washington, so you don't have to. Finseca cares about the financial security of the American people, and we know that the solution to this problem is Finseca stands for Financial Security for All. We represent distribution of the products that actually achieve that for people.
There's been threats to potentially change taxation on life insurance. What are some of the things that you guys have waded through?
There's this tendency, because there are some bad actors out there, because some of this stuff is complex, that we need more regulation. And I love to ask this question. Anybody in the audience to raise their hand if they think that they are under-regulated. I haven't seen somebody yet, but I'll tell you this, there are a lot of lawmakers that think that. We need a voice in Washington, because typically in Washington, if you don't have a seat at the table, you're on the menu.
What is Finseca's approach when it comes to charging for a process?
The reality is, if you don't have any money, and the only way that you're going to be able to access that advice is through...
Maggie, welcome to the BetterWealth show.
Thanks, Caleb. Great to be with you. Thanks for all you're doing.
I heard you speak at an event in Chicago. You represent Finseca, which you'll share what Finseca is all about and what you guys are up to. Loved your update just on the industry. Loved your update on what's happening and what you guys are looking for in the future in Washington. I think you have a quote that says, "We live in Washington, so you don't have to." And you very much care about, financial security for all, but you also are in the corner for the financial professional and trying to help Congress, I believe, the people in Washington, D.C. really understand what we do. It's kind of a running joke is we call this the eraser at the door. A lot of times people come in as clients and you're able to educate them and everyone's on board, and then the next year it seems like they forgot everything. Yeah. And so if that's our experience with the people that are actually working with us, I can't imagine what it's like in Washington, D.C. when they have it seems like thousands of extra things on their plate, and yet people like you, it's a full-time deal seeing like what we can do in this industry. So without further ado, we'd love for you to share a little bit of what you guys are up to, where the focus is, and I'm just grateful to have you on, and I think it's going to be really eye-opening for the people watching this.
Well, I appreciate that very much, Caleb, and kudos first to you, because educating the American people on what's possible and empowering them, that's what I do every day. That's what you do every day. So big thanks to you for leaning in with a generation maybe that doesn't know that they have access to some tools to get them to where I think they want to go. And that's what we do. A lot of people say we're in the insurance business, we do AUM, we do a little bit of annuities. I'm here because of the mission, which is peace of mind. And not for some, not a luxury for the wealthy, but for everybody, and sort of woven into the fabric of the American dream. And we've seen it twice now in 4 years. Ernst & Young has proven it independently. That's a fact, that consumers that work with holistic financial planners get better outcomes than consumers that don't. And so that message we need more of this, not less. And I'm proud. I get up every single day and with a smile on my face, because I know that if we talk to just a handful of more people, whether it's policymakers or regulators or the average consumer, and empower them with the knowledge that you and I both have, we're going to make that person better. And what a cool, blessed opportunity that is. So yeah. Great to be with you, and thanks for the opportunity to share a little bit about Finseca with your audience.
With the person that's not familiar with Finseca, how would you describe it?
Yeah, so Finseca, we live in Washington, so you don't have to. And probably everybody on this call has heard of the American Medical Association, or for doctors, the American Bar Association for lawyers. There are some of the finest financial security professionals in the country came together a handful of years ago and said, we need that. We need a voice in Washington, because typically in Washington, if you don't have a seat at the table, you're on the menu. And we have been. We have been for many, many, many years. We play very good defense. There's a small group of very impactful financial advisors who can tell this story very well. But they knew that we needed, if we were actually going to solve probably the most important challenge for our generation, which is financial security, we needed greater scale. So during the pandemic, probably the worst time ever, a handful of organizations came together and created Finseca. Finseca stands for Financial Security for All. And we represent distribution of the products that actually that actually achieve that for people. So there's got to be a protection side. There's got to be some asset gatherings, the AUM side, and then there's got to be a guaranteed income stream on the backside. And that's sort of our three-pronged approach. People within our membership do a little bit of each, do more of some than others, but that's who we represent. And we have Forbes Shook does a nice recognition each year of the top financial security professionals in the country. To give you a sense of who we're talking about, we have 75 of the top 100. We have many, many, many in the States. And so this is the best of the best, but they know that the tools that they have, like we're here to help make others better. This is an abundance mindset. This is a growth mindset. And they know that if we have scale, we're actually going to achieve what it is that we set out to do, which is financial security for all.
So you're an organization in Washington, D.C. that's really working on behalf of the people that are, advising and selling life insurance, annuities, and assets under management. And you could bundle them into the financial professional. It could look different ways. But with that in mind, what are some of the headlines that have been passed that you think are important to talk about, and some of the things looking forward that are interesting? I know there's been in the past the fiduciary conversation has been like a big thing. I know that there's been threats to potentially change taxation on life insurance, and so I know that those are just two of some of the things that I've seen. But what are some of the things that you guys have waded through, and some of the things that looking forward that you guys are currently working on?
Yeah, I'll give you just a couple, Caleb, and we can double click on any if it makes sense. So I'll give you this analogy. You should try and find this. There's a video of the 1956 women's gold medalist in vault, the best in the world at the time. If you watch that video, it's essentially a handspring over this vault. And you fast forward a couple dozen years later to what Simone Biles is doing, and it's night and day. And it's just 1950 is innovative, right? Like major medical breakthroughs. You've got some extraordinary advancements in space technology. Like this is consumer electronics in the 1950s. A couple dozen years later, Simone Biles makes that look childish, right? And so typically speaking, people think, oh, Simone Biles is the best in the world. I phrase it a little bit differently. I think in 1956, we had that gold medalist. She was good. And I would argue Simone Biles, yeah, she's much better. But the best is actually still to come, in my mind, and we're the ones who get to create it. So there are a whole bunch of people in Washington and around the country, you know this, you mentioned one of them, who don't really understand what it is that we do on a daily basis. What are financial advisors doing? And maybe well-intended, but there's this tendency, because there are some bad actors out there, because some of this stuff is complex, that we need more regulation. And I love to ask this question. If I'm speaking in front of an audience, I ask the audience, anybody in the audience, to raise their hand if they think that they are under-regulated. I haven't seen somebody yet, but I will tell you this. There are a lot of lawmakers that think that, both in Washington and around the country. So yes, the Department of Labor a couple of times now has tried to put to bed an end to the commission-based advice model. But we've seen that. We saw that in Europe. We've seen that in New York with Reg 187, this movement to this fiduciary standard. But I'm not going to give you all the data. The outcome of that is limited access. Yes. And if you think about the number of Americans that are working with a financial advisor and are working with a financial plan, it's about 2/3 of Americans are not. They don't have access to these products. They don't have access to advice. And we have massive problems in this country financially. A lot of people paycheck to paycheck. But I said it earlier, Ernst & Young has proven twice in 4 years that a holistic financial plan is going to give better outcomes to consumers. And so if you unpack that, you got to push back on that. Finseca is product agnostic. Finseca is fee, commission agnostic. I don't care how people get paid. We do believe that you need to work with a financial professional, though, like bare minimum, so that somebody can walk you through. Tiger Woods has a coach. The average American should have a coach. So DOL, a couple times now, we ended up building the largest coalition of independent distribution in history, sued the Department of Labor, and defeated that attack on the commission-based advice model. You fast forward to the beginning of this year, Caleb. the number one thing that folks were paying attention to was the rewrite of the tax code. $4.5 trillion in tax increases on the board, an additional $2.5 trillion in other spending outlays. And our industry, by and large, is a pay for. We were in 17. I mean, we have a number of people that are very wealthy, and so people look at our industry and they've got a target on our back. They don't understand what we're doing, and they think that we have a bunch of money. They don't recognize the value that we provide. And so we went on offense. We built another coalition at the start of this year, and I'm proud to report that this tax bill, regardless of where you're at politically, if you put your purple hat on, which is what Finseca is, we look at this through HR 1 through the prism of financial security. Did our industry were they attacked? Were they asked to pay for this? No. That's the first time in 40 years. Did we get permanence on things like the estate tax, which allows people to plan? Yes. And if your audience isn't familiar with this, they need to write it down. They don't know how to spell it. It's 199A. Permanence and certainty on 199A. It's qualified business income deduction. That's something that was created and expanded to where it is in terms of its certainty because of Finseca. So those three things, the Trump accounts, I give you one last nugget on HR 1. A lot of people don't know this, but Donald Trump is not the architect of the idea behind Trump accounts. He's very good at putting his name on it, no problem. All that is, though, is understanding the core function of what we do, which is compound interest in time. If you plan and you have certainty around that planning, you're going to get good outcomes. So the Trump account. It's $1,000 on the day that a kid's born, and it's allowed to grow. If you take average market returns on that $1,000 for 65 years, at 65, that kid is looking at about $500,000 sitting in that account. $1,000, 65 years, average market returns. If a grandparent comes in, if a nonprofit puts a couple hundred dollars into that account, if we go from $1,000 to $3,500 and we let it sit there, that account is sitting at $1.7 million. And we don't really talk about that. People only start saving when they're 35. The one stat that's really important on the Trump accounts is you go from $500,000, you invest a couple, $2,500 more, you get to $1.7 million. If that kid takes that money out of his account at 18, it's only worth $6,000. Like, we got to educate people on what it means to save, on what it means to empower themselves, to set themselves up for financial peace of mind. And I just mentioned it, it doesn't take a lot, but time is a critical factor. And so if we can educate folks on that, like, we're alleviating a lot of pressure. You know how bad our debt is. And you know that Social Security, which the vast majority of Americans use for their retirement, has serious problems. And probably 2033 is the number. I actually think it's probably 2032, depending on where things go. Like, that is the issue that is going to define our generation. And I'm glad to be sitting on this side of the table with folks like yourself.
Yeah, I was very pleased with the tax cuts personally. Obviously, it benefits myself. It benefits a lot of people that we serve. But on the flip side, I have I'm a parent of a 1.5-year-old, and so it's like I want the best thing for America and this country long term. What is Finseca's approach when it comes to just the debt? Because it does seem like neither party wants to really address that issue. I know that Trump is focused on tariffs, and he's bullish on tariffs being the key out, but then he also talks about using, now talking about potentially refunding or like giving $2,000 to people that qualify, which is great. It's like great from a politician standpoint, but then my question goes like, I know it's not very sexy to pay off debt, but what is Finseca's approach to this, and where do you guys balance? Because we all know you could like raise taxes to 90% and just kill the economy. So it's not as simple as increased taxation, but there's that fine balance of like, it seems like whenever we give something, it doesn't necessarily go to pay off debt. It goes to something else.
Hugely problematic. I mean, you've just nailed it. You've absolutely nailed the heart of the issue. Caleb, I'd put it this way. So Finseca cares about the financial security of the American people, and we know that the solution to this problem is everybody listening to this call. And it's one of the reasons why Finseca was created, is because there is a lack of understanding, depth on these issues, and how people are actually made financially secure. And that starts with a coach. It starts with somebody who's able to map out protection options, accumulation, and then what's the outlay on the backside. And if we start to empower more people with a financial plan, we are going to get better outcomes. I get it. Like, we have a massive problem. There's a great chart on our national debt. And I like to use this cartoon of a snowball racing down a mountain. It says our federal debt is $22 trillion. That cartoon was drawn in February of 2019, 22 trillion. You fast forward to November of 2025, and we're looking at $38 trillion in debt. There's going to be a problem. And one of the reasons why there's going to be a problem is because of Social Security. So say lawmakers are going to absorb this, the general fund is going to pay for it. What does that do to the bond market? That's the ultimate question, and that probably, in my humble opinion, as someone who's been around a lot of very, very smart people, we have a very small window to get this right. Finseca's position is we need more private sector solutions to alleviate the public pressure on that system. Of course, Social Security is critically important. And if we want to keep it around, that means you have to alleviate some of the pressure on it. There needs to be more thoughtful dialogue and conversation around that. We're not going to pretend like we have all the answers, but we're absolutely 100% certain, because of Ernst & Young's research, that part of the solution is everybody on this call, working with more people, making sure that they have access. You know, it's hard as hell to do this business. If you can get through those first 2, 3, 4, 5 years of real struggle in this business, you're in a great spot. But those first 2, 3, 4, 5 years are painful.
A lot of people out.
I'll give you one hopeful, offensive public policy initiative that we're working on right now, which is, how can we help more Americans have a financial plan? We think we can incentivize that through the tax code. Is it a deduction? Is it a credit? To be determined. We're building that coalition right now. We know that the vast majority of Americans take the standard deduction, so it's got to be an above the line. Is it a credit? Is it a deduction? Not sure. But it serves two very important purposes. The first is more Americans are going to work with financial advisors. Check. We definitely need that. And the second thing that it's going to do is it's going to provide more certainty to financial advisors on the front end of their career. Say they can do a couple dozen, 2, 3, 4, 5 dozen plans at $1,000, $2,000, $3,000, whatever it is. Now you've given that advisor a little bit of relief on the front end of their career. And so we will start to see more people coming into this business and staying in this business. And so we think that's two sides to the same coin, but it solves some fundamental problems. So we're working.
So that's something that Finseca is working on from
right
an
now.
Offensive place, because a lot of times you guys are trying to protect what's currently like our industry is coming under attack, and so you're playing a lot of defense. But you're saying, like, what if there's a way to create an incentive for people to work with a financial professional?
Yes.
Would something like this, and again, tell me if this is too soon to ask this question, but would this only be available for fiduciaries who could actually charge a fee? Or what is Finseca's opinion on, like, people that are not 65 licensed or technically fiduciaries doing some type of, like, coaching deal? Like, it can be gray. What is Finseca's approach when it comes to charging for a process?
Yeah, listen, if somebody's a fiduciary, no problem. The one thing that I would say where I think Susie Orman and Fisher Investments are 100% wrong is on the protection side of things. And the reality is, if you don't have any money and the only way that you're going to be able to access that advice is through a commission, we should allow it. And that doesn't mean it's for everybody, but we absolutely should allow it. So to your question of, is this only something that would apply to a fiduciary? Absolutely not. Because it's got to have a protection side of the equation. You have to, if Ernst & Young is right, and they've done it independently twice now in the last 4 years, and they prove that somebody who has protection, asset accumulation, and then some sort of guaranteed income stream on the backside, so permanent life insurance, investments, and an annuity, that's what a holistic plan needs to include. It cannot be one or the other. And the one thing that I would say to those who are sort of in the accumulation space, like, you're missing out on a core protection for your client if you haven't talked about protection options. And so, no, this would not, there's a number of folks who think about this, but from our standpoint and the lens of the independent research from Ernst & Young, it's got to have all three. So there must be a protection option.
Because you mentioned Ernst & Young multiple times. What was Finseca behind this initiative, or what was the process of getting Ernst & Young? And then, in your own words, what did they actually discover in their two independent studies when it comes to protection? Because the way that I explain it is, you have investment people on one side, you have insurance people on this side. A lot of times, unfortunately, they go at each other, and the potential issue, the issue is you could take an arbitrary test. It's like going to ethics class in college. It's like, okay, I passed ethics class, I must be ethical. And so it's like, you pass this test, and now all of a sudden you're a fiduciary. The thing that's frustrating, though, you could put 100 fiduciaries in a room and get 150 ideas on the best 100%. Way to go about something, and that can be frustrating. And then it's almost like, sometimes I know fiduciaries that can't even offer or talk about a product that they get paid commission. So how in the world, Maggie, can you be a fiduciary if you're not even mentioning some products that may be the right fit for the client? I know I asked you 5 questions in one. That's one of my toxic traits.
Good. Your first question, and I'll take them in order, is Ernst & Young this is totally independent. We're not paid for by the industry, not paid for by us. We know Phil very well, as anybody should. Like, sit down with him, sit down with his team. He'll go toe-to-toe with you on the research and how he thought about it. But he wanted to show, given they open with, what is the problem? And we have a massive problem in this country, wherein, on occasion, huge swaths of the American public can't cover a $500 unknown emergency fee. So their car breaks down, their air conditioner breaks, like, they have serious problems. So Ernst & Young sat down and said, okay, how is it that we are going to alleviate some of the pressure on Social Security, on other programs? Like, how do we make people more financially secure? And they started 4 years ago, and they just looked at, sort of, the broad umbrella was, let's look at permanent life insurance, let's look at an investment-only track, and then Fisher Investment, Susie Orman, and then let's look at annuities. And round one, they ran every Monte Carlo that you can think of. The clients who had permanent life insurance coupled with investments and coupled with a guaranteed income stream on the backside had better outcomes. So then they double clicked on it. Different scenario, different interest rates, but they went product specific, and they looked at a whole bunch of different permanent life insurance products. Then they looked at asset accumulation, and they looked at specifically a FIA on the backside. So they came to the conclusion that a consumer that had an IUL coupled with an asset accumulation in the middle and then a FIA on the backside was going to get better outcomes. I would invite everybody, we'll make sure we share the link, go read it. It's only 30 pages, 35 pages. It's well worth it. It's done totally independently. And I get it. There are some who, it's much easier, actually, to just sit in the asset accumulation business. But for those who can't do that or don't have assets there, we can't leave them behind. So no problem. If that's a bucket and that's how they get their advice, got it. I do think you are doing a disservice to your clients by not giving them access to risk options. And I think that's borne out. The data show that. The other side of the coin is, like, how do we make sure that more people are financially secure and they can protect themselves in the event of a horrible accident, tragedy, what have you? And then how do you alleviate some of the pressure on Social Security? Of course you have to. And the bridge that brings them all together in this second study from EY, let's talk about tax planning. talk about income planning. That's how you get at some of these protection products, no problem. So we are in all of the above. It's an and for us. It's an abundance mindset. It's not a you must do it this way. It's let the consumer decide where they're at with their coach. And we need more of this, not less.
Yeah, I try to think how to break things down simpler, and one of the things that was kind of like a new epiphany, but it was interesting because it was like when I first got into this space and in our profession, it was one of the things that it drawed me in, and then you sometimes you forget over time. But it was like just looking at a strategy and asking the question, how many jobs is this doing for my life, for my
Right.
from like how many jobs am I giving my dollar? If you look at the cell phone, everyone has a smartphone, and it's because it's so efficient. It does so many things for us. And when you're really doing a disservice if you're only doing one thing, and that's one of the things that I think Ernst and Young proved and shared is like one of the things with integrating is you're not just diversifying when it comes to risk and growth and taxes, but you're diversifying when it comes to the jobs that you're giving your dollars, and the person that can give their dollars more jobs over time, I think create more options and more outs, and so we could talk all day long about that, but I do appreciate in your own words sharing that. I got a couple other questions for you. So looking ahead, you talked about playing offense. Is there any other things that are concerning to you, or things that you guys are fighting against, or things that we in the industry can do to help as it relates to advocacy, or maybe call our senators or congressmen? Like, what are you guys looking forward to in the future on the exciting side and kind of the negative side?
Yeah, I'll give you two. The first is, if you want to get involved, not everybody can give their time, but I just had a board member tell me this, but everybody can give a little bit of their treasure. If we grow, the theory of the case is if Finseca goes, we're going to end the year at about 13,000 members, Caleb. And when I started 4.5 years ago, we had just shy of 5,000. We're the fastest growing trade association in Washington. We have big, lofty goals. And the way that we not only have a seat at the table in Washington, but we drive the conversation, where you go back to my analogy of the 1956 gold medalist to Simone Biles, the best is yet to come, and it's ours to create. And that happens with scale. So the first thing I would say is, come join the party. Lend your name to Finseca. Help us grow this movement. If you're a financial advisor, you're looking for ways to grow your business, understand what the best of the best are doing, this is the place to do that. There's two sort of things that I will point to that folks need to be aware of. On the state side, we mentioned DOL. We skipped over New York 187. The other question that I ask often of audiences is, who does business in the state of New York? And people raise their hands. And then I ask people to keep their hand up if they enjoy doing business in the state of New York. I've been all over the country. There's not a single person who's left their hand up. And like, we're working through that. We have had good conversations. All that takes is somebody giving a little bit of their time and their willingness to educate the regulator, the policymaker on the other side of the aisle, the other side of the table. In New York, and the data show it, policy counts down, premiums are down. Like, the people of New York are not getting access to advice the way that every state around them and the rest of the country, all of this stuff is growing except in the state of New York. So they have an access problem. I will tell you this. There are a lot of well-intended regulators and policymakers who are just misinformed. And we saw a little known story. California was thinking about doing what New York did on 187, except it was even more extreme. And we built a coalition. We got on the ground. We got in the room with the lawmaker that introduced the proposal, and we sort of walked him through systematically what had happened in New York, and asked him.
Maggie, can you actually explain what actually happened in New York for those of you that aren't aware?
Yeah, so Reg 187, if you think about it, is worse than a fiduciary standard, which is what the DOL is trying to do. So they have God, what's the simplest way to think about this is regulators think about consumers and they sort of wrap them so tightly in bubble wrap that they start to suffocate the marketplace. That's the simplest way that I can explain Reg 187.
And how did that show up in New York? I know that there's many insurance companies won't even do business in New York.
They pulled out. Exactly. We actually, Caleb, this is one of the reasons why Finseca is involved at the state level, because we were not involved when Reg 187 was happening. And it has so hurt consumers in New York that we launched a state advocacy arm to make sure that this type of thing didn't happen again. And when California, after we sort of went through the education incredible coalition, ACLI, NAFA, IRI, we got into a room, we pushed, we educated, we explained, we articulated in simple terms to this lawmaker. What California ended up doing was walked it back to the NAIC best interest standard. We know that there is a solution to ensure that consumers can be protected. We know what that looks like, that we worked with the NAIC to develop it, and it doesn't undermine the state regulatory model. That was a win. California became the 45th state to do that. And I share that with you only because these types of ideas, they don't die. You have to continue to explain the case. The win for us as an industry, if we can go on offense, is it makes those defensive postures not only far and few between. It puts us in a different position with lawmakers. Wait a second, why am I attacking the very people that EY showed me are going to actually help solve this problem for consumers? And so that's one. The second thing that I'll tell you is on those Trump accounts. We are right in the middle of the regulatory process there. We're going to be on the ground. We're going to be on the ground with Treasury as they think about this. What does this look like? And we actually have built a Savers Coalition in Washington for anybody who wants to get involved, lend their voice, understand what it means to help educate their policymakers. Like, it's when you unlock that position and you leverage public policy to help you achieve what you're trying to do, you've entered a different realm. That's what we're trying to unlock with scale.
I love it, Maggie. Thank you. What is your approach what's Finseca's approach when it comes to the many people on the internet dunking on insurance and annuities, saying it's terrible? I mean, I could name a ton of names. It's become kind of like a trend where it's like, work without a human. One of my next questions is AI. AI is now creating, and AI is incredible in what it's able to allow people to do. What is your guys' approach on, like, how do we fight against that? It's probably not through regulation. I think we don't, that would be kind of very hypocritical. But, like, do you think we need to have more people make videos? Do we think we need to have more people, like, push back? Because it's maybe easier to say it, and then you get this, like, insurance especially and annuities get such a bad rap, and then you just, I guess I that's not really
it's a great question. No, it's perfect.
But
it's
like, what do you guys think? How do we play offense just in our profession and our industry when so many people are having a paradigm that insurance and annuities are a ripoff?
Well, the research proves that it's just a fact. The challenge is, there's a lot of people that don't understand it. That's just simple truth. And one of the reasons why Finseca was created was to push back on that false narrative. And if we're not just in the insurance business, we're here to help people's dreams come true. And when they put their head on the pillow at night, you want to make sure they're sleeping easy in the event that something doesn't go right, in the event that everything goes right. They've worked with a coach. That requires a person. And we can leverage technology. We can do a much better job of the system that we've built to make access easier. But I do believe that every person, every family is unique, and that they should have, again, Tiger Woods has a coach. Why aren't we empowering everybody's smartphone has Google Maps in it? All you're asking an advisor to do is to show you the way. and then educate yourself a little bit more. Think about things a little bit differently. Understand the product set. I was with Bobby Samuelson this morning, and the one thing that he challenged everybody in the room to think about is we're so fixated on forecasts. Instead of let's just simplify it from an advisor standpoint. Let's just educate folks on what the product does. And Bobby is probably one of the most well-versed people that I know, and I do this for a living, and I'm surrounded by the best in the industry. And every time Bobby deepens his understanding on the product sets that we're talking about within permanent life insurance, he says he buys more of it. So, like, we can go toe to toe, but it requires us to sort of lean in a little bit, approach things with humility, but make friends. Make friends, because the story that we have to tell is really good. And if the best is yet to come, it still is on us to go create it.
Yeah. Maggie, thank you so much for coming on the show. Is there anything else that you would like to share before we wrap up?
Join us, Caleb. Tell everybody that we have a lot of fun, and we've built one heck of a nice organization, and our runway is long, and it's youthful, it's energetic, it's there's rigor, there's push pull, and people are debating, and it's great. And we've got an entrepreneurial minded membership, but there's no better place to be than working toward the financial security of the American people. So such a blessing, such a blessing to be with you, and just grateful for all that you're doing.
Yeah, thank you, Maggie. I'll say, if you're watching this and you like this piece of content, or if you have questions, make sure to put that in the comments, because I'm hoping to have Maggie back on here in the future. And we read every comment, and some of your questions might actually end up in our next interview. So Maggie, thank you. Continue to keep up the good work, and appreciate what you're doing. And I look forward to hearing the response on just our community and just the thoughts they have as it relates to where we're at. So thank you.
Appreciate